Good morning. Welcome back to Professional Insights, brought to you in part by the National Referral Network. And this morning we have David Olivencia. It was a tongue tie. He is a tax attorney and, from what I understand, an accountant with Wilson Hand. David, good morning. How are you?
Good morning. I'm doing just fine. How are you, Mike?
I'm doing great. Hey, so David, just before we got on here, you mentioned where you're at. I've got to ask, where are you at right now?
I am in Kissimmee Airport in a hangar waiting to pick up my aircraft to fly it back to Orlando.
How long is that flight?
3 minutes.
Okay.
At 140 knots.
That is awesome. So look, I appreciate you being here, David, especially as you've got so many things going on. So let's just jump into this real quick. Just real briefly, explain the importance of tax planning on a tax attorney standpoint. Now, I understand that you're both, right? There's the tax attorney and accounting, but a lot of professionals are working with their CPAs that may just be happy historians and just file their taxes and not a lot of input. So just real quick, importance of tax planning as we go into this fourth quarter of the year.
Well, the importance of tax planning is you want to have the proper tax planning to reduce your taxable income, right? Before you get hit with high income or high tax dollars, right? Where you can do some scenarios for tax planning to reduce your overall taxable income and have economic benefits back in your pocket, right? And having the proper legal structure to help you mitigate some of the high tax dollars that you incur by having high wages or high income, reducing it through legal strategies, right, that are proven factorial through IRS channels and internal revenue coding rules. And that'll help you mitigate a lot of your high tax dollars.
So David, there's a lot of a lot of buzzwords about, tax loopholes. And correct me if I'm wrong, but I've always told people there's no such thing as a tax loophole. Either you participate in the tax code or you do not. Anything beyond that is called tax evasion. Is that?
That's correct. There is no tax loophole. That's a myth word that's been carried around for centuries. However, using the tax code to use the proper tax code for planning to your advantage and participating with the tax code is advantageous to reduce taxable income.
I love it. So what are some of the common mistakes and misconceptions that business owners should be aware of going into the fourth quarter?
Basically, at the end of usually through the fourth quarter, a lot of misconception is that a lot of tax planning people or other folks usually says, oh, buy a building, buy this, buy that. And usually the best way to have a proper tax plan for the fourth quarter is investing in 1245 property and using some of the tax rules and regulations that are on the books to reduce your taxable income before December 31st, 11:59 p.m. So,
gotcha.
Yep.
So, and then with that, Dave, look, I know there's been a lot of changes since COVID within the IRS and the taxes and all that stuff and moving the deadlines. What are some of the tax laws and regulations that are being implemented, maybe not in the fourth quarter, but fourth quarter and into 2024 that business owners need to be aware of?
There's some of the credits that the business owner gets. I know the QBI is going to start to be phasing out. Section 168K is going down from 80% to 60% and so on.
Now, what is that? What is that real quick, David? What is that
The QBI is qualified business income deduction that you're below a threshold. You can take up to 20% deduction on the QBI for S Corp 1065s and Schedule C's of your 1040 tax return. Section 168K is bonus depreciation, which was 100%. Now it's phasing down from 80 to 60. Some of the green energy credits are being phased out, and some of the other credits that people take on their 1040 are going to be phasing out in 2024 as well. And some of the new rules and regulations are going to be changing the tax code to higher tax rates too as well. So that's something to watch out for as well.
Now, a lot of these topics we can go into a deeper dive, and maybe we can reschedule for, talk about some of these tax credits, because a lot of business owners don't understand that there are federal tax credits and state tax credits. We won't get into that because it's a great conversation. But when it comes to tax credits or some of the things that you just talked about with the qualified business income, how important is it for business owners to maintain their records and their documentation in terms of income and cash flow?
Well, I can tell you this based on a 25-year history of going through audits with the IRS for different clientels, not having books and records and proper documentation can cost you a lot of headaches, time, and money, especially when you come in front of an IRS agent. Keeping books and records and accurate books and records can smoothen any transition with any audits, bank loans, any credit cards, or just trying to get some debt instruments to help your business sustain itself or just raise capital to buy assets and so on and so forth. It's very detrimental to business owners to know that keeping accurate books and records not will only help them, but will keep their records, they'll keep them clear and steer them clear of any audits or any issues that can arise in the future, because audits are just, it's like winning the lottery, right? You never know when you're going to get picked, but it happens. And if you're not having these books and records, can be very, very detrimental to your pocket and your wallet.
I mean, I think there's a pretty good correlation in terms of happiness when it comes to winning the lottery and or getting an audit.
Right.
I mean, those are very similar things.
Correct. So I always advise the clients and anyone that I work with having proper accounting records and proper books and records, employment records, tax records to meet the requirements of the Internal Revenue Code. Not only that, also the state codes. And any institution that you want to borrow money from, you should have always 100% accurate records.
Now, I know that audits are not, the conspiracy theorists will tell you that audits are planned and they're targeted, but that aside, is keeping correct books, does that reduce your chances of getting an audit or having an audit?
Well, it doesn't reduce your chances of getting an audit or not getting audited. What it does reduce the time amount spent in an audit before the taxing agencies going through documentation, which it can be costly for you paying a professional to sit there 20, 30 hours for an audit versus having everything formulated in a tax risk-based scenario where it might take you 3 hours or 4 hours or just submitting a couple of documents and invoices said and done, because everything ties in to your financial statements and your tax returns.
Now, David, when we talk about financial statements, right, you're a tax attorney, you are an accountant, there's a CPA, there's CFOs, there's controllers,
Yep.
bookkeepers.
Yep.
A lot of business owners, and we don't have to get into the definition of each one, but a lot of business owners will contact us as the National Referral Network and say, hey, I need a bookkeeper. In reality, they need a controller, yeah. Right? So how important is it to have a team of professionals, and when do you pull that team in?
The importance of having a team of professionals is depending on the size and the growth of your business. Some bookkeepers are great. They're pretty much CPAs without a license and CFO and controllers because they've been doing it so long. And then again, there's some high-end level accountants and CPAs who sometimes need the assistance of a bookkeeper to get the books done. But having the right team at the right time as your business grow is very important, between the bookkeeper, the controller, the CFO, and the CPA, to have a level of understanding where your financial health is at a given point in time to make your business either grow or lose your business. So, that all comes with proper planning and having the essential tools. And when you have the essential tools in the toolbox, you'll be able to get the job done much quicker than having to search for the tools.
Gotcha. And so when it comes to tax planning strategies, because you just mentioned all those things. I mean, so when it comes to tax planning strategies, how important is it for business owners to manage their cash flow?
Well, cash flow is and tax planning are kind of two different worlds apart, right? Because cash flow is to understand how your business is doing financially, and if you can meet your obligations, right, at a given point in time or a given period in time based on your either black line or blue or red line, right, on your financial health. And tax planning can help you pretty much increase your cash flow at the end of the day. So although they're two different worlds, they come together combined, because if you run into a high tax, do you have the cash flow to pay the tax? Versus if you do the proper tax planning, it might increase your cash flow further rather than decreasing your cash flow. So two worlds apart, but they coincide in the tax planning world.
Oh, that's awesome. So David, we're going to wrap up here just real quick. Any final thoughts or strategies or comments that you'd like to provide to the listeners?
Basically, I would recommend getting together with your tax advisor or a tax attorney or your CPA. Do a tax plan now. Coming into the fourth quarter, make sure that you have your I's dotted, your T's crossed, so you don't get into an issue with the IRS and not having the cash flow to pay your taxes. And maybe a proper tax plan will help you reduce any taxable consequences that you might have coming into the new year with proper strategies.
And that brings up one last question. You mentioned this in the fourth, and we've talked about the fourth quarter. When should a business owner start tax planning? I've heard, obviously January 1, you want to start up with the tax plan. But if they haven't, June, October, when should somebody start tax planning?
For my cup of tea, I usually start in month 6, and I usually do forecasting models and projections based on historical information and the first 2 quarters in order to get me into the third quarter to understand where the tax consequences are going to be in the fourth quarter. So I always recommend halfway through the year using historical analytical data from the prior year and current period to get you into the tax planning scenario.
Wonderful. That's great stuff, David. Thank you so much for the time. Once again, this is provided by the National Referral Network. We're here every Tuesday morning with professionals to provide these types of professional insights. If you have any questions or concerns, please leave them in the comments. We will respond. If you have a topic that you would like us to cover, please leave that in the comments below. David, thank you again. Travel safe, by the way. Fly safe.
Thank you, Mike. Thank you.
Thank you so much for the time, and we really, really appreciate it. Have a great day.
You're welcome. You too. Have a great day, Mike. Bye-bye.